Good afternoon and welcome to this ACT webinar on unprecedented market conditions, financial risk management challenges and solutions. I'm James Lockyer, Development Director here at the ACT. And before we start, I'll quickly explain some technical points about our webinar setup. There's a menu bar across the bottom that allows you to open various windows, and you can move these around your screen, resize them or minimize them. The yellow button with a question mark is for help if you have any technical difficulties, and the purple Q&A widget opens a new window. You can send questions to us by typing in the window. Don't wait until the end to send in your questions. Please send them in as they occur to you, and we'll deal with them at the end of the presentation. And of course, we won't disclose any names. I should add that a recording of this webinar will be available on the ACT website in 2 days' time, along with a separate copy of all the slides. We're delighted to have speakers from Chatham Financial and VimpelCom, who have substantial experience in the practicalities of developing and delivering risk management solutions. Chatham Financial have sponsored today's webinar, so on behalf of us all, can I thank them for that support.
Thank you, a pleasure.
Financial markets are in substantially uncharted territory, with minimal to negative interest rates, QE and uncertain growth prospects causing material distortions for asset managers, and with FX and commodity prices reacting to political and economic uncertainties such as the US election, the prospects for China's economy, Brexit, and the consequences for Europe. Risk management policies are more important than ever in controlling threats to the business strategy, while enabling it also to profit from opportunities. And the means by which policies can be implemented are developing fast. There's a lot going on, and today we'll be hearing from Paolo Esposito, who's Executive Director, EMEA Corporate Advisory at Chatham Financial. And Paolo is responsible for Chatham's corporates advisory team in Europe, advising corporates, private equity funds on how to structure and implement financial risk management programs. Previously, Paolo worked in corporate finance roles in the automotive industry, and he also lectures on financial risk management on university programs. Also with us is Ramon Tolk, Director of Treasury Operations and Control at VimpelCom. Ramon is responsible for VimpelCom's Treasury Operations and Control team in Amsterdam, including cash management, financial risk management, and associated valuation, reporting, and controls. Previously, he worked in Treasury and accounting or external reporting roles for European listed corporates and banks after starting his career as an auditor and Treasury consultant with Deloitte. We'll then finish with discussion and as many of your questions as we can get through. So, let's start with Paolo.
Thank you, James. So, the purpose of this webinar today is to describe some of the peculiarities of the current market conditions, particularly with regards to the aspects that influence a company's risk management profile and risk management decisions. We'll see that both the currency and the interest rate market are in conditions that challenge most of the corporates nowadays. They challenge the ones that did not have a hedging program and were caught off guard by some of the currency shocks, for example. And they challenge the ones which instead had a policy, but now are wondering if their programs are still appropriate in market conditions that are structurally different than before. Then, Ramon will discuss how VimpelCom manages the risks arising from having significant parts of their operations in emerging markets. And finally, we'll close with a case study on a challenging interest rate risk management assignment for a client of ours. So, with this said, we've seen the agenda, and before we start our content, please just let me quickly introduce Chatham Financial. If you could move on to slide number 9, please. So this is us, and here is Chatham Financial. So Chatham Financial is the largest independent advisor on financial risk management in the world. We provide advisory and technology solutions for risk management. We have roughly 400 employees that are located in 6 offices in the world, And we work with approximately 1,800 companies, both public and private, ranging from some of the largest Fortune 500 and FTSE 100 companies to smaller ones. We support them in mitigating the risks that arise from interest rate, currency, commodity strategy, whether it is for one-off extraordinary situation, like a refinancing, for example, or for managing ongoing exposures, like in the case of an operational hedging program. In many cases, we end up executing the derivatives transactions on behalf of our clients as well. And in this regard, we close approximately $500 billion of derivatives every year. In this way, we believe that we develop some very valuable expertise in pricing derivatives, and we gain insight on how different banks price different derivatives. We then provide derivative valuations and hedge accounting through a combination of advisory and technology. We have, for this purpose, a team of 45 hedge accounting advisors that do support our clients effectively in designing the most effective strategy from hedge accounting standpoint, but also in running the periodic hedge accounting process at month end or quarter end. Finally, we have teams that specialize in negotiating ISDAs and in providing regulatory support for EMIR and Dodd-Frank compliance. With this said, unless there are any questions, we can start with today's content. And the first topic is a quick update on currency markets. So let's see what happened during the past months. We are coming from a period of sustained volatility in the global currency markets. In the past year and a half, there have been 7 currency shocks that can be qualified as currency crises. In chronological order, we had the CHF, the Euro, the Chinese Yuan, the Brazilian Real, and the Argentinian Peso, and finally the Japanese Yen. All these currencies had movements beyond the 2 standard deviation range, meaning extreme movements to which the mathematical models attribute less than a 5% chance of actually happening. In this chart on this slide, we show the evolution over the last year for GBP, Euro, and US dollar. Looking at GBP, we can comment around the recent evolution. Immediately after the leave vote, the pound dropped 15% versus US dollar on a 30-year low from 150 to 130. Some commentators also feared a parity with the dollar, but 2 months after, we can see that now the pound is stable versus the dollar in the 128, 132 range, and parity seems highly unlikely as of now. Looking at the future, banks have produced regularly forecasts for GBP US dollar, and for 2017 there is a very wide range. Some banks believe that is on the 115 exchange rate, others are positioned towards 150. So there's not much guidance that we can get from that, from those forecasts. At the moment, the forward curve is flat at 130, meaning that as of now, this is the level that can be fixed contractually for the future. Looking at the pound versus the euro instead, GBP is weaker as well versus the versus euro, roughly 14% compared to pre-Brexit levels. And the average forecast for 2017 is flat at 0.86. Flat is also the forward curve, but as we know, the uncertainty and the volatility are not going away. We have upcoming elections in Germany, France, and some important votes in Italy. So with such wide movements, some of our clients found themselves with hedges that have become significant liabilities. For example, with companies that were hedging revenues back into pounds, and with hindsight, they might wish they hadn't hedged. In some cases, these liabilities have breached the limits of the credit lines that banks have made available, and we also heard of some banks that have started making margin calls for collateral. On the other hand, we have clients that have hedged their foreign costs for the mid to long term. They're very happy now, as these companies have effectively weathered the current shock. They have for now protected their profitability, and in reality, they have bought themselves some time to adjust the business model of their commercial strategy. So, in this context of extreme volatility, some clients approached us to discuss if it was the case to break the existing hedges, maybe paying the existing liability and get new hedges in place at market rates, or whether it was time to review the hedging strategy. So we usually hear questions and concerns on the validity of hedging strategy after significant market swings. And since we are talking about hedging strategy, we can see what we believe is our recommended approach. We believe that it makes sense to start with an analytical review of a company's risk, and this is represented on the left side of the slide. We start by capturing the company's exposures. We then proceed to quantify the risk to the metrics that are most relevant to the companies. These are usually some economic indicators like EBITDA, cash flow, net income. And then, in this context, we highlight the currencies that are major contributors to this risk. In this analysis, we use the volatility of the exposures to highlight which currencies are riskier. We factor also correlations between exposures to assess potential offsets between the various risks. So through our model, we can then test different risk reduction strategies and quantify what risk reduction they actually achieve. And then we use this information as a base for discussion. In fact, our approach is that we always want to integrate this quantitative analysis with some more qualitative considerations, like the company's knowledge of the market, the knowledge of the competitor's business to develop a competitive strategy, and also information on the elasticity of demand to price. So combining these two complementary approaches, we get to the building blocks of our program, so which cover what to hedge, which instruments to use, since different instruments will determine different changes to the risk profile of the company. We determine how long to hedge for, how frequently to execute, and so on. So questions that we hear from clients usually are around what happens if volatility increases? What if a specific correlation between two currencies break? Should we change policy or maintain the course? As an answer, we can say that we promote regular monitoring of a program. We do not suggest a set and forget approach, especially after there are changes either in market conditions, like we've seen, for example, on currency, commodity, and so on, or in the company structure, like company changing the cost base, changing the business model, etc. So we can see more about this in the upcoming case study. So what we represent here, it's a UK industrial business with operation in UK and Europe, and with production facilities both in the UK and in China. The top left chart shows the currency flows in 2015. The right chart shows the flows in 2016. Let's see. In 2015, the GBP inflows and outflows almost offset each other. Most of the net cash flow, in fact, was foreign, euro, which is risky from a company's point of view. The company therefore implemented a hedging program which was covering and hedging these euro revenues. In 2016, instead, we see a different situation. The company has in fact moved some production costs from GBP, from the UK to China, paying in US dollar. And as a result, in 2016, even though the company has increased flows in foreign currency, the company produces more cash in GBP, which from a risk management perspective is positive. What we also see is that euro and US dollar flows have opposite directions. Now, taking into consideration that euro and US dollar have a degree of correlation between the two, the real question is if an increase in foreign cash flow could actually determine a reduction in the aggregated risk, which is a counterintuitive concept. The argument is the following. If euro and US dollar move versus the GBP in a correlated fashion, when US dollar costs increase, in GBP terms, also euro revenues will increase by a similar fashion, therefore producing a beneficial offset, a so-called natural hedge. So what happened was that this change in the cost structure for 2016 triggered a conversation with our client, mainly around how to trust this euro-US dollar correlation. If the company trusted the correlation 100%, then the strategy would have been not to hedge euro and US dollar, letting the respective movements offset each other. A more prudential approach would be instead to hedge both, as if the correlation at some point breaks, the company would still be protected. In any case, hedging only one currency, like they were doing in 2015, they were hedging only euro, hedging only one currency would be wrong, as this decision would increase risk because it will remove a positive offset, even though if it's not a perfect offset. So through our discussions with the company, the decision was finally to hedge euro and US dollar in pair, however, at a low percentage. This reduces also the transaction and program management cost, and lets the company benefit at the same time from some natural offset between euro and US dollar. The idea is, however, to monitor this correlation over time, and as we said, it's important to review the hedging program periodically to assess if there are different market conditions or if the company changes the structure. But let me throw a question at that. What if the two foreign currencies, instead of euro and US dollar, were CNY in US dollar, or euro and DKK, for example? So two currencies that are actually very strongly and stably correlated, or that are even pegged to each other. This would probably determine a different choice, since the company would rely more solidly on the offset between the two. So we see companies that, because of the risk tolerance and the sensitivity to a specific risk, they still wanted to hedge some controlled exchange currencies like Euro CHF before it actually dropped the peg. So since we mentioned the correlation as one of the many factors that is worth considering, with this slide we can quickly look at the historical correlation between euro and US dollar. You will see that for the past 10 years, the correlation has been positive for 82% of the time, on average a value of 0.42. So this cannot really be ignored. Currently the value is at 0.74, and what this means is that if this correlation holds, if GBP US dollar exchange rate moves by 10%, Euro GBP will move in the same direction by 7.4. And this information can be valuable for companies that are in the process of making the risk management decision. So that we can take a break from market updates, and in a minute Ramon will introduce VimpelCom and share with us the challenges that a company operating in emerging markets faces every day, especially in volatile periods like this. We at Chatham work with VimpelCom, providing them the system and expertise to value derivatives and to apply hedge accounting. So we know that during this presentation, Ramon will discuss how they use cross-currency swaps to obtain the desired capital structure, and we thought that it would be good to give a quick recap of how the cross-currency swaps work. In short, companies that need pound or euro funding, rather than issuing debt in the currency that they ultimately need, they have the choice of tapping the US debt and capital markets, and then convert the US dollar debt back into euro or GBP via a cross-currency swap. The diagram at the bottom shows the flows of the cross-currency swap. This starts with the conversion of the debt proceeds into GBP. Then, from the cross-currency swap, the company receives US dollar coupons that will offset the US dollar payments that are due on the debt. And net, the company ends up paying GBP interest. At the maturity of the cross-currency, there is usually a final notional exchange, even though this is non-mandatory. The final effect of the cross-currency swap is therefore that the company have obtained synthetically a debt that is pound denominated. But why would a company do this? As a start, the US market has lighter covenants, the documentation requirements are simpler, and they offer more flexible terms. Possible, they also offer longer maturities, and they're very developed in some industries. But also, what's very important, through the cross-currency swap, there can be some pricing advantages. Converting from US dollar to, say, pound, not only the effective rate paid on the pound will be lower, because GBP rates are lower than the US dollar rates, but there is also an additional advantage given by a further component that is called the cross-currency basis, which is added or deduced from the pound rate. Let's look at it in more detail very quickly. So this component, cross-currency basis, is driven by the market and represents the preference from investors to hold one currency over the other. You will see that in periods of market turbulence, like in 2008, in 2011, this cross-currency basis went highly negative, even above 100 basis points. Well, in those circumstances, and still today, there are advantages in issuing debt in US dollar and converting it to euro via a cross-currency swap, since the euro rate will be further reduced by a beneficial basis. As of now, if we look at the 5-year case on euro, that basis is...
First, give you a brief introduction. VimpelCom is the 7th largest mobile telecom operator in the world. You probably won't know the company as we have our businesses mostly in emerging market countries like Russia, Ukraine, Algeria, Pakistan and Bangladesh, usually not the countries you will go for your holidays. Only Italy, where we operate under the brand name Wind, is not an emerging market country. The presence in these emerging market countries gives us several challenges from a treasury point of view, and especially when the currencies of those countries went through the roof as from the year 2014. Prior to those events, the focus of our FX hedging strategy had been mostly on hedging the short-term cash flow forecast, e.g. hedging the dollar-denominated capex in Russia. Long-tenor hedging was perceived to be too expensive due to high interest differentials between the currency pairs. The currency headwinds that we have faced caused us to revise our hedging strategy. The most important thing here is to first consider what is your main objective with the hedging strategy. What are the most important financial metrics that could be impacted by any currency headwinds? Is it your net profit? Is it certain financial ratios, such as our net debt EBITDA? Can it be your budget for the upcoming year? Anything else, or a combination of these? For us, besides, of course, the data is considered to be the credit rating sensitivity to this, and the fact that this is our most important debt covenant. Besides this, we also look more thoroughly now at getting natural hedges in place, partially by getting additional funding in local currencies, as that already gives a natural hedge and limits your net debt EBITDA sensitivities, but also by amending procurement contracts from, for instance, dollars to local currencies. So with our large suppliers, we try to negotiate more and more local currency pricing. Another point we have looked at over the last year and have considered is to apply proxy hedging. Several of our currencies to which we are exposed, for instance the Russian ruble, Algerian dinar and the Kazakh tenge, are oil related. So we have been looking at whether we could apply proxy hedging by using oil related derivatives as a hedge for those currency exposures, especially as for some of the currencies no liquid FX derivative markets are available. Looking backwards over the last, for instance, 5-year period, the correlation seems to be high, but we have done some further testing and regression analysis that we would need to enable hedge accounting were failing. So for that moment, we haven't applied any proxy hedging yet. Another topic to take into account are the conditions and circumstances to which you are faced. It is important to have a continuous, clear understanding of the working of the financial markets, and especially in the emerging markets we are in. Central banks tend to have a strict regulatory framework, but it's important to understand if this will evolve over time and to be up to date on that point. Then it's also important to have clear communication with all the stakeholders on the hedging strategy, and especially on any inability to achieve the ideal picture. Because as a treasurer, you don't want to be blamed for not having your hedges in place. So if there are reasons why you cannot achieve the perfect picture, it is important to make sure that your stakeholders understand why that is. And that can be, for instance, the conditions and circumstances I just mentioned. For instance, not having any availability of derivatives in the markets, or if hedging is perceived to be too expensive because of illiquidity. On the transaction execution side, we faced impact as we used to be hedging dollar-ruble exposures through zero-cost collars. At some point, late in the year 2014, the cap levels of the zero-cost collars were so outrageously high that we didn't consider those reasonable anymore, and we switched towards FX forwards as a hedging instrument. So as mentioned, the most important objective for us is to have the net debt EBITDA hedged from a currency point of view, and that can be done by rebalancing your debt currency mix. That can be done two ways, either by refinancing the existing dollar debt with local currency debt, or by additionally hedging dollar debt with cross-currency swaps to our local currency that we have. Considerations that play a role in deciding between these two are, well, first is managing your counterparty credit risk on potential derivative mark-to-market. Because if you use cross-currency swaps to rebalance your debt currency mix, you have to be mindful that the fair value can be volatile based on currency developments. A huge positive fair value imposes you towards credit risk with the banks with whom you have the transactions outstanding. Therefore, when applying cross-currency swaps, you should consider implementing credit support annexes to your ISDA, as that will cause the positive mark-to-market to be offset by margin postings. On the other hand, you should also be aware that this may have disadvantages from an operational point of view, and it may impact your available cash balance or cash flows due to regular margin payments. The second consideration to take into account is the all-in cost. Cost levels may differ due to the currency basis spreads applied in cross-currency swaps, as just explained by Paolo. And those may work in your advantage or disadvantage depending on the currency pair you're looking at and which way you're hedging. Another item that may play a role is that credit spreads applied may be different in financial markets in one currency versus the other. For instance, we have seen that spreads applied in our ruble financing sometimes are only 200 basis points, while the credit spreads applicable for our dollar funding is, for instance, 400 basis points. On the execution side, it is important to plan your usage of cross-currency swaps, and especially if the amount is sizable, you should really plan ahead. Make sure that you have your credit lines available with the bank, especially if you are not hedging or applying credit support annexes. And it's also important to consider the volume of the transactions needed compared to the liquidity in the market, as you don't want to be moving the market. Now I'll give it back to you, Paolo.
Thank you, Ramon. That's great. Right, we can now move on the interest rate market. We'll try and move quickly on the update part of this. The title of the webinar references unprecedented times. One current condition, which is effectively a first, is the current presence of negative rates on several interest rate indices. It's the case for Euro, CHF, DKK, JPY. And it's calculated that roughly $8 trillion of securities now offer negative returns. We'll not talk about why central banks do this, but we'll focus on the implication from a risk management point of view. And also with regards to the current slide, it's sufficient to say that the green bars show us that both the current Euribor and the current LIBOR rates are lower than they were 3 months ago. The real question is, where is the pound going? It's now at 0.25%. Is it going to get to zero or negative as well? This slide shows instead the swap rates. This means the fixed rate that you can get on a variable rate financing by entering into a pay fixed derivative. We have plotted the 1 and 5 year swap rates for both GBP LIBOR and Euribor. And for example, you could fix today the next 5 year of variable Euribor interest at a level of minus 0.30 basis points. What the graph also shows is that on the LIBOR, while the 1 year swap is stable, the 5 year is a historical minimum, and on the Euribor side, while 1 year swap continues to decrease, the 5 year is again at historical minimum. What this means for borrowers is that borrowing for 5 years or for 1 year comes pretty much at the same cost, and therefore is relatively cheaper to hedge for longer. And we've seen a tendency from our clients in fixing the interest payments for longer to provide certainty. But moving on, with interest rates being close to zero, below zero, it's impossible not to mention floors. Our treasurer colleagues that have financing in euro should be familiar with this, but it's becoming increasingly relevant also for companies that finance themselves exclusively in pounds. Floors are usually included in the financing agreement via the definition of the rate. In a normal positive rate environment, by using a swap to hedge a variable rate, the net result of debt plus swap is that the borrower pays net a fixed amount. This is because the receiving floating leg of the swap offset perfectly the pay floating leg of the debt. And this works also in presence of negative rates, as the two floating legs still offset each other perfectly, leaving the pay fixed as a net. So these are the first two cases that we included in this slide. Looking at the third case, however, when the rates are negative and when there is a floor in the loan, the swap do not work anymore as a hedging because the two floating legs of swap and debt do not offset each other anymore. And the borrower ends up paying the floating rate plus ends up paying the fixed rate plus the absolute value of the negative rate. In effect, the company is not paying a known fixed rate anymore and is not hedged if rates go negative. In fact, the more the rate drops, the more the company will be paying. So we've seen that the result of having a floor in the loan is that the borrower does not receive the benefits of rates going below the floor level, whether it is 0 or 1%. And this is a cost. We quantified the missed benefits in the slides for euro floor at 0% and from pound floor as usual at 1%. As of now, we can see that the company could be paying over a 4-year period up to 1.3 million euros of missed savings on the interest and up to 2.6 million pounds over 4 years on a 100 million pound loan. But cost is not the only issue. As we've seen in the previous slide, floors also introduce complications from risk management purposes because companies cannot really hedge with a swap. The chart at the bottom of the slide shows the interest expense in case of increasing and decreasing rates. Ideally, a company would want the interest expense to be a flat line, like the green dotted one. That means that whatever happens to the underlying rates, they always pay the same. They are hedged. In reality, the red line represents what happens if a company is hedging with a swap and there is a floor in the loan in case of negative rates. So in order to get a flat green line, the company needs, in reality, to buy back the floor that is included in the financing. And the price of the floor is definitely higher than the cost that we have highlighted in the upper part of this slide, because the cost of the floor will also include the premium for the volatility. So as we see in the case study, we have structured a solution that can avoid paying this high price. So we can move on the case study. This case concerns a company that in 2014 was acquired by a German company that was acquired by a private equity fund. The company works in the service business. And in 2016, they were going through a refinancing. Since the company had grown, they needed more capital, and they could achieve a better refinancing rate. The problem was the mark-to-market of the existing derivatives. That was a liability of 1.5 million. There was a presence of 0% floor, which made things more complicated. So the objectives of the companies were to comply with the minimum hedging requirements. They had to hedge 200 million for 3 years. They wanted to achieve certainty of interest expense. So they wanted a green, flat line of their interest expense. And they were not happy with the increasing expense if rates drop. They wanted to avoid the settlement of the 1.5 million liability, and they wanted to minimize the upfront hedge cost. So they didn't want a product with upfront payment. So in brief, we see at the bottom of the slide, company wanted to move from 160 million hedge with 2 banks to a 200 million hedge with 3 years, but they didn't know which banks to select and which products. So let's look at the possibilities in terms of process. The company could terminate the old hedges and execute new ones. This is usually suggested by the bank counterparties. In reality, they would have had to pay the mark-to-market plus incurring in high execution costs. Think about it, the bid-offer spread on the termination, execution charges on the new transaction, plus new credit charges on the swap. We calculated that roughly they would have paid more than 300,000 euros just on these charges, which is not ideal. The other alternative was to maintain the whole hedges and layer new ones on top. However, the documentation didn't allow for this because for the ISDA, a refinancing was a termination event for the swap. So finally, the third option was to restructure the existing hedges from 160 million for 2 years into 200 million for 3 years, not by terminating, but by embedding the old swaps into new hedges. The advantage of this approach is that if it's done properly, it reduces significantly transaction and credit costs, which are estimated in 350,000 euros. And the company can really model and structure the hedges starting with a clean sheet. So what do? We check the interest of the 4 bank counterparties and collected their credit capacity and pricing expectations. We then work with the banks to understand what assumptions, input, and methodologies they were using for the pricing, and we determine the most competitive one. From a documentation standpoint, we had to work with the legal advisors of the client and of the banks to obtain a waiver that would let the old hedges survive the refinancing. So we said that the simple path for a client that does not want to be exposed to falling rates is to enter into a swap and buy the 0% floor back, effectively neutralizing the floor on the loan. This is priced in option A on the slide. This strategy achieved an all-in rate of 0.39, and this would be the standard approach. Instead, what we did was to structure a different hedge, which consisted of a 0% cap. This is a strategy that achieves the same exact risk profile of swap plus floor, but comes with significant savings. Before initially, the company does not pay credit charges on the swap, because it enters into less transactions, 1 instead of 2, and because the cap was priced more efficiently than the floor. So through this strategy, we achieved an all-in rate of 0.32, which is producing savings of 420,000 euros compared to the option A. To note that these savings are in addition to the savings that were due to the restructuring on the derivatives instead of terminating them. So in summary, when looking at the different objectives and priorities of the clients, we felt pretty good as we obtained that the client did not pay the termination of the existing swaps, 1.5 million liability, by making all derivatives survive. We had to actually innovate the derivatives to the bank that finally was the hedge counterparties. And we produced 100,000 euros of savings of this. We then achieved the risk profile that the client wanted, meaning not to be exposed to negative rates. And as seen, this was done through a cap at 0%. And finally, we deferred the premium of the cap to avoid any upfront cash outflow, all by employing a much cheaper solution than the standard cost of action. So this is a 0% cap strategy which is very effective, and we have implemented it already with success. But a few words of caution, as this strategy requires a bit more care in documentation and in the structuring phase. So please let us know if that is something that could be of interest. And with this, I personally finished my part of the presentation, and we are happy to take questions.
Okay. Well, we've got very limited time for questions, unfortunately. I think I've got one here, which actually I'd like to direct to Ramon, actually, which is about counterparty risk with banks, and how the question was asked in the context of actually low interest rates on deposits. I think it's relevant whether you're depositing, transacting FX or whatever. Mm-hmm. How do you guys manage the counterparty risk on your banks?
Yeah, well, we have in the whole group a sizable banking landscape where we operate with about 120 different banks in the countries where we are in. So that's a sizable banking group we take care of. First of all, at headquarter levels, we set the counterparty limits on each of those banking counterparts. So that's done by looking at credit ratings, looking at credit default spreads of those banks. In some cases, these are not available because local banks in countries like Pakistan and Bangladesh, they usually don't have these ratings. Then we go into the financials of those banks. We look at the financial ratios that are most important.
And you do that analysis
analyzing indeed the bank financial statements, and based on that, determining the limits we want to assign to those banks.
Yeah. And you do that within your team?
Yes.
Let's have a look. Oh, we've got time for one or two more.
We have a
Yeah.
question on policy.
Sorry, how you were saying?
We have a question on policy. Do you want to read the question?
Yeah, no, there's a, again, I'll paraphrase the question slightly, in that I think for both of you, maybe more for Paolo, how many companies actually, how many companies' risk management policies were good enough to cope with the consequences of, let us say, Brexit as a solid example, but actually extending that, do you feel are good enough to cope with, excuse me, the various sort of event challenges facing companies at the moment? I mean, there are lots coming up as well as Brexit.
Yeah, well, Brexit impacted many companies in many different ways. We know that there are companies that would suffer increased costs and decreased revenues because of this. Depends on how the companies are correlated to the economy. Think about real estate companies. Others will be impacted by Brexit changing the asset values. Others from FX risk movement. In reality, well, it's not difficult to spot that Brexit would have had an impact, but companies could not really forecast what was going to happen. So,
and indeed, some of that impact, a lot of that impact is still work in progress, isn't it?
It is still work in progress. So what we can say in this regards to great impacts and shocks that are significant is that some companies have more sensitivity to those than others. So if that is the case, some companies could take some preventative measures. And we do that through running some scenario analysis on a specific company that comes to us and said, if Euro CHF peg breaks, we are going to be impacted significantly. What can we do to mitigate that? So it depends very much on the sensitivity of the individual company.
Sure. Ramon, any thoughts on that? Or, I mean, how have you got? I mean, you guys operate in a world which is full of shocks, I guess.
Yeah, indeed. And for us in Amsterdam, it is something we had to get used to. We were not used to that, especially up to 2014. Also in the emerging markets, everything seemed to be quite stable. And then, of course, all of a sudden, all of the currencies started to develop against us. So that really was for us, let's say, a first-time experience to have to deal with it.
Okay, thanks very much. Well, look, sadly, I think the time has come to wrap up. Firstly, my thanks to our presenters and to Chatham Financial for their support. I'd also like to thank everyone who joined today's session, and I'm sorry if we didn't reach your question in time, but as I mentioned at the start, we'll be uploading a recording of this webinar on the ACT website, along with the presentations in 2 days' time, and we'll send you the link. Just very briefly, looking forward to the rest of the year, we have a variety of upcoming events. We've got the event in Hong Kong on the 21st of September, the Middle East Annual Summit in Dubai at the end of October. We've got the annual dinner in London, training courses, and also working capital, tech, and cash management conferences coming up. So we'd be delighted to see you at any or all of those if you can manage it. Thank you very much for listening. If you can spare a moment to provide feedback on the webinar, we'd be very grateful. Please select the feedback widget in green at the bottom of the screen, and the facility to do this will remain open for a short while after the webinar ends. From all of us here, thank you and goodbye.
Thank you very much.